Historical development of the U.S. monetary system. The American monetary system's historical development reflects a transformative journey from fragmented, community-based banking to a centralized framework capable of supporting a $150 to $200 trillion economy. Before 1791, banking in the United States was localized, with community banks serving as secure vaults for gold, silver, and property deeds. These institutions issued their own notes, typically backed by precious metals, but these were accepted primarily within local communities, limiting their utility as trade and travel expanded across regions. The money supply during this period was constrained, estimated at $10 to $15 million, and lending was minimal, focused on trade, land speculation, or small businesses like mills and shops. Many Americans homesteaded without loans, relying on self-sufficiency in the frontier economy, which reduced the need for borrowing but hindered broader economic integration due to the lack of a uniform currency. Local banknotes were often unreliable, vulnerable to counterfeiting, and lacked trust outside their issuing communities, creating inefficiencies in commerce and necessitating a more cohesive financial system. In 1791, the first Bank of the United States, established in Philadelphia, marked a pivotal shift by introducing fractional reserve banking, a system that allowed banks to lend beyond their reserves, typically holding 10% as cash or precious metals. This enabled banks to create new money by crediting borrowers' accounts, expanding the economy beyond the limitations of physical reserves. The first bank issued standardized banknotes, convertible to gold or silver, which were more trusted than local notes, facilitating transactions across regions and fostering economic stability. Local banks deposited assets, such as gold or silver, with the first bank, receiving its notes or credit, which they used for lending or transactions, enhancing the system's reliability. Despite its success in stabilizing the young nation's economy, the first bank faced political opposition, particularly from advocates of states' rights who distrusted centralized authority, leading to the expiration of its charter in 1811. The Second Bank of the United States, chartered in 1816, continued these functions, managing government funds and issuing uniform currency to further integrate the economy. It played a critical role in handling federal finances and stabilizing markets, but like its predecessor, it encountered resistance, notably from President Andrew Jackson, who viewed it as an overreach of federal power. The Second Bank's charter ended in 1836, plunging the U.S. into a period of financial disarray from 1836 to 1913, during which thousands of state-chartered banks issued their own notes. This proliferation led to rampant counterfeiting, inconsistent valuations, and frequent financial panics, such as those in the 1870s and 1890s, which disrupted trade and eroded public confidence. The money supply grew chaotically, reaching $20 billion by 1913, but the lack of centralized oversight underscored the need for a more robust system. The Federal Reserve Act of 1913 established the Federal Reserve, marking a turning point in American monetary history. The Fed standardized currency with Federal Reserve notes, replacing the patchwork of state banknotes, and provided regulatory oversight to prevent financial instability. By 1913, the money supply had expanded to $20 billion, reflecting the growth of banking and commerce. The Fed's creation addressed the inefficiencies of the pre-1913 era, ensuring a uniform currency that facilitated trade across the nation and laid the foundation for modern monetary policy. The shift to a fiat system in 1971, ending the gold standard where the dollar was valued at $35 per ounce, introduced greater flexibility, allowing the money supply to grow to $21.560 billion by 2025. This transition accommodated the demands of a globalized economy, where digital transactions and international trade required a currency untied from finite commodities like gold or silver. The evolution from localized to centralized banking addressed critical challenges, including counterfeiting, mistrust, and economic fragmentation, enabling the system to support a $150 to $200 trillion economy. The first bank's introduction of standardized notes reduced fraud, while the Federal Reserve's establishment resolved the instability of the 1836 to 1913 period, fostering trust and reliability. The fiat system's flexibility supports modern commerce, but requires careful management to avoid volatility, setting the stage for understanding the mechanics of money creation and circulation, as well as the roles of key institutions in sustaining this dynamic system.